the Bureau of Labor Statistics now says that you're going to change careers, not just jobs, but careers 5 to 6 times in your working lifetime. The days of going to work for a large corporation and staying there until you retire, those are gone. And they're gone not just for people in their 20s, as many people who are being laid off or re-engineered, as is the common buzzword, they discover that time and time again. But I think that many people, and especially 20-somethings, are realizing that your career is truly in your hands, whether you're an entrepreneur, whether you work for a small to mid-sized company, or whether you're with the Fortune 500. You have to look out for yourself in that regard.
And there are 5 things that you want your members to do every day, 5 questions. Is that right? And I don't know if these are the questions or not, but just so that you don't screw them up and I don't screw them up. Are these the 5 questions? If they are, would you mind reading them to the viewers?
Yeah, they sure are. The first question is, there's a better way to do everything. What is it? The second one, which is really my favorite, which is, why is my boss my boss?
Yeah, and I want to stop you right there. Why is my boss my boss? Bradley, now look, the things that I just talked to Claire about, this idea of why is my boss, this is what gives you guys this kind of reputation.
Who's to say it's a bad reputation to have? I think that questioning anything, that's the way most organizations get better, that anything gets better, is by wondering if there is a way to do something, and if not, as Tom says, is there a better way to do it?
Well, I like that there's a better way to do everything. What is it? But why is my boss sounds a little arrogant, if you don't mind my saying so.
You had said it earlier, I mean, about people just because they come into a certain position because of tenure, because of time. If that person's not necessarily qualified to do that, why shouldn't that be questioned?
You're going to question them, is what you're saying.
Sure.
Do you recommend that in your book or not?
Well, I think recommending that if there is a better way to do something, and if that person is fully qualified and you can learn. I mean, how many times we're seeing layers and layers of middle management being laid off. Why? Because they're stagnant, because they're not doing anything. They're obviously being laid off for a reason besides budget cuts, because of ineffectiveness. And I think that questioning is not necessarily a bad thing at all.
Okay.
Well, I think also that we're kind of missing the question. If you dig a little deeper into the question, it's not disrespect at all. If you're a boss, you're a boss for a reason. That's because you've got more experience, you've got better ideas, and you're able to help your employees. That's the kind of boss I'm going to be. But if you're a boss that is so scared of your employees, then maybe there's a reason for that. And then the question, I think, stands for itself.
Hello, I'm Nikki McCuistion.
And I'm Dennis McCuistion, and welcome to our first of 7 challenges that financial institutions will face in the future, the challenge of people.
And you know, Dennis, those scenes that we just saw are only part of the challenge of tomorrow's workforce. In a few minutes, we're going to explain just why we believe that people are going to be one of our major challenges, and we're going to discuss layoffs and morale issues, the 20-somethings or Generation Xers, and the impacts of both diversity and demographics.
That's right, Nikki, and we'll even talk about why customers, not just employees, will be a challenge. But first, we'd like you to know that this series is based on the research that we did that went into our book, The 7 Challenges Facing Bankers in the Future and How to Meet Them. Now, the other 6 challenges, in addition to people, are change, regulations, competition, profitability, time, and the economy.
Dennis, it's also important that everyone watching this program really understand that everyone faces several, if not all, of these challenges, and those challenges might be a little different for your bank in terms of the order or the way that you work with them.
And I think that's important too, because as Nikki said, you may have a number 1 challenge that's different from people. Your challenge may be regulations, number 1. And the way we figured this out, and the reason that we put people first, is because from time to time we would give the 7 challenges to clients of ours. So the bankers would all sit around. In fact, they did it in French Lick, Indiana for the first time, about 3 years ago. And we gave them the 7 challenges and said, rank the 7 with number 1 being your most difficult or most important challenge. And 11 of the 14 tables that did it in French Lick, Indiana, all came up with people number 1. So a lot of people will say that if you can solve the people challenge, then you can probably solve the rest of it.
And I think I'd agree with that. Now, according to Workforce 2000, there are 4 key trends that I think we should look at. Those 4 key trends are going to shape the last years of the 20th century with tremendous impact. The first one is that the American economy should grow at a relatively healthy pace. The second one is, and I think we'll all agree with this one, service industries are going to become a much larger share of the economy by the year 2000. The third one is that the workforce is going to grow slowly, become a lot older, more female, and more disadvantaged. And the fourth one is that new jobs in the service industries are going to demand much higher skill levels than ever before, according to Workforce 2000.
Well, I remember when I went into the banking industry, and as you know, that was at the ripe old age of 14.
Right,
I knew a couple of things. First, that I'd always have a job because nobody ever got laid off in banking. The second thing I knew is that I wouldn't have to sell. And now, after I've waken up after all these years, I've found out that neither one of those necessarily holds true.
Well, all of us will agree with that because we've seen all kinds of layoffs and mergers. Matter of fact, Chase Manhattan recently announced that they're having layoffs of between 8.5% and 17% of their workforce.
Wow.
Which breaks down to approximately 3,000 to 6,000 people. And as you can see, the other major banks are doing very much the same.
Well, the problem with those layoffs, and of course, people are trying to cut expenses, as all of us know. 86% of the big companies that downsized in the last 5 years had morale problems. And the American Management Association, which did that study, found that only half of them ended up with more profit. So those kind of things are difficult. And then we also have to wonder about the USA Today article that was out a few days ago, where the secretary was in one caption, and the next caption showed the secretary totally replaced by a computer. So those things are going on right now.
So there really is no job security any longer, is there?
Unfortunately
Now,
not.
bankers also want employees who have really high energy and certainly some intelligence. So these are some of the issues that we're going to be exploring.
Well, while they do want high energy, they do want intelligence, they also want people who will tell the truth. And one of the problems today is, well, let me just ask you, have you ever had anyone come in to apply for a job and a couple of things on the resume didn't quite look right? And then have you ever tried to check those things out?
Oh, you can't.
Well, it's very difficult. Well, people won't tell you the truth. And so when you call someone to ask them about their job in the past, and they'll say, well, you know, they were here, they were employed at some time. Now, there's a book that we ran across, which I find interesting, and the name of the book is this. It's the Lexicon of Intentionally Ambiguous Recommendations, or LIAR for short. And it says that there are some very interesting ways to give someone a recommendation, tell the truth, so to speak, and yet not say something negative about someone. And let me give you a couple of examples. Let's say that someone has an employee with interpersonal problems. He might say on a reference letter, I am pleased to say that this person is a former colleague of mine. Secondly, he might say you have someone who's lazy. They might say in writing, in my opinion, you will be very fortunate to get this person to work for you. Or they might be a criminal. And so how would you give a criminal recommendation? You could say something like, he's a man of many convictions, or I'm sorry we let her get away. And then finally, for the untrustworthy candidate, her true ability is deceiving. Now, people watching this, and I'm sure you're the same way, if you get somebody who says something on a resume that you don't believe, you try to check it out. And yet, our experience is that many people coming in, especially today, will say that they have all these computer skills, and in fact, they may have just heard of that particular piece of software. They'll put it on there as to say they're an expert in it.
I think you're being a little bit cynical, but
well, I am,
maybe
yes.
said tongue-in-cheek, some of those seem to really sound about right.
Well, especially if it comes from a 20-something.
Well, very cynical. You know, we talk about the 20-somethings or the Generation Xers, and we have a graphic to show you because the younger folks today do have different values than you and I certainly did and do. And if we look at some of those values, they're much more me-oriented, they're self-oriented. They come first, and that's all right as long as the job is being done. They tend to feel rather cynical because if you look at all of these mergers and layoffs and acquisitions, they don't know if they can trust the gold watch at the end of the 25 or the 50 years. They're also materialistic. Money is a lot more important to this 20-something generation than it was to the older generation that we may still have in the bank. Their adolescence is extended, meaning that they want to stay younger, longer, play harder, be more young, and stay there. They want quantity time, time for themselves. which is not something that some of us really thought about.
Not just the quality time that we used to talk about.
Not just the quality time, but quantity time, blocks of time that they can take for themselves. And one of their biggest values is they want to have fun, and they want to have fun on the job. Now, I don't know.
Banking.
I don't know if that equates with banking. I think that we can incorporate that, and we're going to be talking about that later on. They're also slow to commit because they've recognized that the trends are showing that why commit? You don't know if that job is going to be secure. You certainly can't count on the bank or the company standing behind you. Let's go a little slowly until we start building up that trust issue. And finally, they're not impressed by authority. I think we've all experienced or seen they're challenging the boss. I think probably more than any other generation that works in the bank. If they have something to say, if they believe they're right, if they believe the boss is wrong, or if they just want to make their point, they're going to challenge. We recently did a TV show on the Generation Xers, and let's see a clip, see how that works.
Virtually everybody said, my parents are workaholics, and I want none of it. I want to work to live, not live to work. They want balance, they want life to be more fun, and they want work to be fun.
Which is not bad, but they come into the workforce, they're working for someone who expects something to be done, and they want to come and play and goof off and that sort of thing. It creates a little bit of a problem, doesn't it, Claire?
Well, or they may want a flexible schedule so they can goof off after work and have an opportunity to pursue hobbies. Sometimes work isn't the most important thing in their lives.
You know, one of the things that we found out in talking to and about the Generation Xers is that many of them, of course, don't see work as the most important thing in their life, and that's not necessarily bad. Many of them are very, very smart, very, very bright, which we like to see. However, a lot of the Generation Xers have an education that leaves a lot to be desired, and I think you know what I'm talking about. When they come into work for us, they can't spell, they can't string sentences together, and heaven forbid, they can't do arithmetic and addition without some sort of fancy calculator. So the education level, because of our public education system, in our opinion, leaves a lot to be desired. And in a society today, when we need high tech as well as high touch, to have someone who doesn't have the education level is a challenge for us.
And of course, as customers become more sophisticated, they're looking to work with people who have more education and the common sense that goes along with that. So I think what we're seeing, and the trend is that companies are spending a lot more money to educate folks within the bank or within their organizations to bring them up to speed on the things that they're going to need in order to do the job. We also have to take a look at the diversity issues, the demographic issues. And I think it's important that we see how the population is aging, because that also has to be factored into the way we treat our customers. As we look at this graphic on the median age for the last 80 years, what we're going to notice is that people are getting older. We're going to have to treat them differently, have new products, have new services to offer them.
Well, I'm glad to be getting older myself, but I understand the problem.
And we also have to take a look at the folks who are coming into the workforce, because we're dealing with a very different population now. The people coming into the workforce now, 15% of them are going to be white, mature adults, males. 42% are going to be white, native-born females. Another, 13% are going to be native non-white females. 7% native non-white males. 13% immigrant males. 9% immigrant females. And there really is, it's a terrific market for diversity. We're going to have people within our banks who will be able to speak the language that the customer speaks. And these are all very positive things. But what we're also going to have to factor in is that we are dealing with people of many different nationalities, different ethnic groups, religious groups. People are different. That has to be factored in. And I think it's going to be very positive, but it is a trend we have to pay attention to.
Well, there's no doubt about that. And also, you're going to see what the worker of today considers important in a job. And it may be surprising to you. Open communication, as an example, the effect on family life, things like that is what they're looking for. And by the way, wages didn't even make the list because wages were only mentioned by 35% of the people.
And Dennis, customers are a lot more sophisticated. What with internet and the capability that people have to surf at night, They probably know more about some of the banking products and services than maybe some bankers do. If we look at the demographics, someone who might be born in the year 2010, 1% of them might live to be 140 years of age.
Wow.
If their children live with them, those children might be 105 years of age, living with them, by the way. And if they have grandchildren, the average age is going to be age 78, and they might also be living with them. The household of the future is going to look very different. The customer of the future is going to look very different and demand different products, different services, a lot more sophistication. We have to be up to date with that.
Well, I think that's the other problem, the challenge of people, as we said on the customer side. Loyalty is a challenge. They're not as loyal to your bank as they used to be. Many of them will leave today for what, 25 basis points? That's typically what we hear. So the loyalty factor is a real problem. Of course, one of those problems is our lack of loyalty to them. Sometimes we haven't done the job we should for them, and that's a problem. The other challenge with people from the customer side, though, is that challenge of integrity. Back in the old days, back when I used to watch my dad loan money and when I used to loan money full-time, one of the most important parts of that interview would be when we looked that customer in the eye and would say, "Well, how long we knowed you, son? Your folks grew up around these parts, did they?" We looked at integrity because character was everything. Now, you're going to be looking at a bankruptcy chart and you will see the numbers going right on up through 1994, where the bankruptcies have just mushroomed over the last 15 to 20 years. The integrity is not there like it used to be. And in fact, in many cases, Nikki, when someone signs a note today, they're promising to pay you back if it's convenient, not no matter what.
Dennis, it's very obvious that if we can meet the people challenge, we can really succeed in the future. So, thank you for joining us as we've discussed why layoffs and changing values and changes in demographics and diversity are going to continue to make people our very best asset. And for many of us, also our very biggest challenge.
Until next time, have a great day, and remember, a company is known by the people it keeps.
We are in the midst of the most widespread transition, I think, in the history of the human race. That's my own personal opinion. A lot of people think of it as a cycle, and I think that's a mistake. In this process of transition, there's going to be a lot of pain. We cannot prevent all the pain. There's going to be companies that close down their doors, as we've already seen. There's going to be many people losing their jobs, which we already see. What those people that are moved to action can do is do what they can on an individual level to see that their company or their organization changes, or do something different and start something anew that might alleviate some of that pain and trauma.
I'm Dennis McCuistion.
And I'm Nikki McCuistion. Welcome to the Challenge of Change. When John Renish talked about unprecedented change on the clip that you just saw from our PBS television program, he was right on target. In fact, if Dennis and I had been sitting here in 1989 and had made these predictions, would you have believed us? First, that the Berlin Wall would be torn down and pieces of it sold as souvenirs throughout the world.
Second, that the Soviet Union will cease to exist.
That Israel and the PLO would join forces and form a state on the left bank.
And that two country folk from Arkansas will buy the Dallas Cowboys, 2 Super Bowls within 5 years. Would you have believed that? And what if I predicted that 2 other country folk from Arkansas would be elected co-president, and that the female half of the team would submit social legislation not seen since FDR?
I wouldn't have believed that.
I wouldn't think so.
And would you have believed that you would have been paying less than 2% on savings in the last 6 years? And how about long-term fixed rates? We've been refinancing home mortgages at rates that have not been seen in 20 years. Now that's really pushing it, because we're talking about changes that happen every single day, and yet most of us don't like change. Let me prove it to you, because I think this might feel a little bit uncomfortable. Dennis, I'd like you to try this as well. And you too, please. How about, now take a risk here, how about you take off your wristwatch from whatever wrist you may have it on.
And they can dangle it like this. We can see
You
the
may do
Rolexes,
anything
whoever
that
has a
you like.
Rolex.
And let's put it on the opposite wrist.
This is
like
hard.
so. You may not be able to clasp it quite right. But we challenge you to leave that watch on the other wrist for at least the end of the program. How's that?
I think that's a good idea. I would tell you that people in your bank probably don't like change either. Let's talk about your board members for a second. We get a chance to do a lot of work with boards all over the country. And a couple of years ago, I happened to have been in Wisconsin. And over 4 days, I spent some time with 500 board members. And I asked them if they like change. And of course, they said, of course we like change. Then I asked them this question. I said, how many of you sit in the same chair every month at your board meeting? As you might imagine, virtually everybody in the room held up their hand that they did. And here's what I challenged them with. I said, let me ask you, will you, by next year, agree to at least change your chair to see if you can get in the mood for all this change that's going on in this industry? And they said, yes, we'll do that. Well, I went back the year after. What I found the year after was, I asked them the same question. I said, how many of you have changed your chair this last year? 2 boards of directors, only 2 out of 500 board members. But the interesting part, Nikki, was when someone came up to me after one of the breaks, and he said, you know, I wasn't on the board last year, so this is the first time I've been here. I didn't want to say it in front of all these other people. He said, but the first time I went to a board meeting, I went into the boardroom, there were chairs there, I just went in and plopped down in one, there was some materials in front of me. He said, I'm sitting there and everybody else is starting to sit down, and all of a sudden, I noticed that there's someone standing above me. And I look up and I said, can I help you? And he said, you're sitting in my damn chair. Now, I didn't believe, he didn't believe, you know, that there was just one chair that was assigned. But that's the toughness about change, is that people just will not move their chairs. And if they won't move their chairs, they're probably not going to do much else in change.
And they're not going to change what needs to be changed in the bank. So, Dennis, while it's true that board members don't want to change, the scary part, I think, is that according to Workforce 2000, what they had to say about all of this is that the chief obstacles to productivity and growth in services and institutions are individuals who fear change. It's true that change is a real challenge for many of us.
Yeah, both personally and professionally. And let's watch now as Dan Burris does a little clip for us here. Dan is a futurist from Milwaukee, Wisconsin. Listen to him as he talks about change.
People say that they don't like change. And of course, I maintain that that's not true. We love change. As a matter of fact, babies are born loving change. They prefer rapid change, Dennis. So what kind of change don't we like? And the kind of change that we don't like is change where our ability to control our own destiny is ripped away from us. That's the kind of change we don't like. And that's what's happening right now. We don't know where to invest our money, where to put our retirement. We don't have job security anymore. Our whole world has been turned upside down. And even whether you're a Fortune 500 company, one of the floundering 500, or a Fortune 500, either way, Fortune 1000 company, or a small mom and pop shop, you can't count on tomorrow looking like yesterday anymore. And that is kind of scary.
Dennis, Dan is right about change. For example, how about the consolidation of financial institutions? More than 1/2 of all of the thrift industry has disappeared. Credit unions are merging. In 1934, there were 14,146 main offices of commercial banks. The latest figures that we have for 1994 were down to 10,451 main offices.
Well, as a matter of fact, Nikki, in the last 12 months alone, 600 banks have gone away, and that's with almost none of them having failed. In fact, several industry experts have made predictions about the number of banking entities remaining in the year 2000. Now, I want to differentiate between the number of banks and the number of banking entities. There are less entities because obviously some people own more than one bank. But BAI and Arthur Anderson did a study called Vision 2000. Their prediction by the year 2000 is that 7,300 banking entities will still exist by that time. Now, John McCoy, in his book Bottom Line Banking, predicted only 5,000 banking entities by the year 2000. And Sheshanoff, all of you know Alex Sheshanoff, is predicting about 4,000 banking entities. And just to give you an idea, it's not just banking. Countrywide, which is the largest mortgage company in the country, laid off 2,000 of their 4,500 workers just last year.
So we can safely say then that the structure of banking is changing in other ways also. And interstate branch banking is one of those.
And obviously, interstate branching is accelerating consolidation, and so is competition. These changes are much of what led to the people challenges of layoff and morale. So let's watch as our 20-something guests discuss change.
we talk about technology and computer skills there, but realize that technology is changing so rapidly that even the skills you know today and being able, Windows 95 is coming out very soon, which is going to completely change the upgrades on other applications. So you're going to need to relearn everything. The importance is not which technologies you know, but it's the ability to learn and adapt quickly. One of the things I think is very important about this generation and why we are better prepared for the new workforce than anyone else is because of that change. Change is a buzzword that's thrown around a lot by many people, but we look at change in a corporate setting, large or small, and as Claire mentioned earlier, it comes back to how we were brought up. We grew up in an environment where almost 50% of us come from some type of broken home, myself included. You're used to change going from house to house on weekends. You have seen our parents put in the 60, 80, 100-hour weeks only to be laid off, fired, have a midlife crisis or a heart attack, whichever. And for us, we're used to that change, whether we realize it or not. And so I think that for today's workplace, that really prepares us very well for that change.
Absolutely. I think it's very difficult for many of us to change. And one of the things I find when I interview 20-somethings about what their most frequent requests of managers are, one of them is walk your talk, practice what you preach. You talk about change, you talk about empowerment, and yet they talk about the baby boomers of being guilty of not always doing what we say we believe in.
That's right. And that's also due in part to our inability to deal personally with so many changes at one time. You may remember the book Future Shock by Toffler, which is now popular again. And in it, he talks about that there are so many changes in society and so many changes we constantly have to deal with and work with, that eventually what happens is we're on overload. We become more anxious, we can't handle it, we fall apart.
Speaking of fall apart, I doubt that there's anyone watching this program who is as old as I am, but in the event that you are, you may remember the early days. Back in the early days, we did most things by hand. And in fact, I actually posted the general ledger, what we call the Boston ledger, by hand. And in college, had a great job putting checks in alphabetical order. And I was good at it until they went on computer, and I had to learn how to put checks in numerical order. Have any of you ever gone through a career shift like that in one day? I mean, that was tough. Now, the technology changes have worked me out of jobs many times because after that, they got a reader sorter. I didn't have to put things in any kind of order, and I had to go do other kinds of jobs. All kinds of changes going on.
You're a lot older than I thought, huh? And Dennis, since those days, the competition has really changed. There's more of it, things move faster, we have to be on our toes, we've got to deal with these changes.
Well, not only competition, but regulatory changes as well. Now, on the next segment, we're going to talk about those regulations, how we got them and all. But the key thing about regulations I want you to remember here is they're always changing. And because they're changing, they create stress and, of course, cost to us.
There is also, of course, market share, which will be very different in each market, so we're not going to quote you figures on that because they're all over the board.
Well, they are, but most people would say that banks have lost at least half their market share in the last 30 or 40 years. Now, we've talked about the challenge of change due to human nature resisting it. Isaac Asimov said it this way. He said, the problem is we all experience change and the vast majority of us don't like it.
Well, I like change, and I certainly recommend that you learn to love it too. Now, until next time. Oh, wait, by the way, I think we forgot something. Speaking of change, and until next time, speaking of time, remember that watch that you put on the opposite wrist? Maybe some of you returned it to the other wrist way before we've been asking you to, but how about now? Take it off, put it back. You're going back to your old habits, aren't you? So, until next time.
Hello, I'm Dennis McCuistion.
And I'm Nikki McCuistion. And this segment is about Dennis's favorite subject, the regulatory burden.
Well, you're right, Nikki. It is my favorite subject in that I, like most financial executives, get so aggravated about the subject.
Well, I believe that the one statement that we've heard over the last few years from people just like you is that banking is not as much fun as it used to be. And we continue to hear it even now when financial institutions are making record profits.
Well, what we want to do in this segment is not to explain the nuances of the latest change to HMDA, CRA, or Truth in Savings. Instead, we will give you a broad perspective on the regulatory burden. We'll look at reasons why regulations are a challenge, the history of banking regulations.
And then we're going to briefly touch on other non-banking regulations that affect all businesses, including financial institutions.
Well, finally, Nikki, we're going to give them some good news about deregulation efforts.
Good news? So, let's begin with a definition of regulatory burden. Defined broadly, regulatory burden consists of any opportunity losses or cost-causing activities that are necessitated by government actions and would not arise in a normal course of business except for governmental policy. And Dennis, what do you see as the major reasons for concern over regulation?
Well, when we did our research on the book, The 7 Challenges, here's what we heard from you. There are at least 4 factors which cause problems: cost, aggravation, competitive factors, and customer impact.
In our book, we cited several studies done by the ABA, the IBAA, and even the regulators themselves. And while the costs were huge, there was also a wide range of estimates.
Well, that's why the chapter on regulations is the largest one. Nobody really knows for sure what the cost of regulations are, but here are the estimates that we have. First, the latest ABA numbers are 12 billion. IBAA studies show about 11 billion, and the regulators' estimates themselves vary between 7 and 17 billion. And it's important to keep in mind that only certain regulations were covered in most studies, with fiducia being omitted in some.
And Dennis, if our calculations are correct, that means that from 10 to 35% of a bank's expenses can be directly traced to regulatory burden.
That's right, and that can create some real aggravation to a bank's management and shareholders. But you know, it's not just the aggravation of expenses, it's much more than that.
As in the problems that we face when we're trying to teach people how to sell or provide quality service. You know, some employees are simply so confused over regulation, they can't really give good service.
Precisely. And if the employees of a financial institution get so incensed over CTR forms, Reg CC forms, rescission forms, then it's hard to stay competitive and concentrate on the customer.
And speaking of competition, the other big complaint that we hear is that many non-traditional financing sources, such as GMAC, GE, Farm Credit, and others, they just don't have to comply with the laws such as the Community Reinvestment Act.
That's true. Now, don't be deceived. All these competitors are overregulated. It's just that they're not as overregulated as most financial institutions, and there's the justifiable concern over being able to compete. In fact, regulatory burden is now a real issue among different sized banks. The larger institutions can use it as a competitive advantage because while they too have costs, they can better afford whole departments to handle the burden, and thus, as a percentage of total expenses, their costs are 1/2 or less of those borne by smaller institutions.
So let me speak to this last issue, that of the impact on the customer. Now, there are 2 really important points that we need to make. First of all, someone has to pay for this. Those costs are going to be passed on to the customer, and they complain. Just the other day, you were on Channel 11 in Dallas talking about the cost of some of this regulatory burden and compliance issues, and consumers are becoming a little bit angrier about this. There's also the time and aggravation factor. Remember when we refinanced our house just a couple of years ago? There were 40-some-odd pages of documentation that, frankly, I don't even remember reading.
Well, I didn't read it either, I can assure you.
We just signed it. So, Dennis, I think most of the people watching this tape may not have a really good and total understanding of just how this industry got so regulated. Do you mind giving us a little bit of history?
Well, I'll be glad to, though it'll have to be more limited than that in the book. So let me just hit the highlights. First, my basic premise. Government has been involved in banking from the very start. And once government creates a problem, it will try to fix it, thereby creating more problems.
Boy, you sure sound cynical.
Well, I am cynical, and you will be too when I finish. Let me take you back to 1827. Now, 1827 was when the first deposit insurance scheme was tried in New York State, and that's when we got the first regulator. So deposit insurance regulations, 1827. Moving ahead to 1863, the National Banking Act was passed, created the Office of the Comptroller of the Currency. The first federal regulator was created in 1863. Well, coming forward to 1913, We find the Federal Reserve Act was passed in that year, and that created a whole nother set of regulations and gave government even a bigger part in the financial institutions game that we're playing. Now, the Fed was formed to help alleviate some bank panics and some problems with money. Unfortunately, it created some problems and helped to create the Great Depression in 1933. So we have this Great Depression. Everybody's out of work. People are in bad shape everywhere economically. So what do? We have 10,000 banks closing. We decide that we need some way to guarantee people their money. So we form the Federal Deposit Insurance Corporation in 1933.
Well, so far so good.
Well,
but-
so far so bad in some cases, because all it did was create more regulations.
Okay.
Deposit insurance, more regulations. Then we come on up to, and I'm skipping a lot of regulations, but 1968 was a watershed time. And I was a full-time banker in 1968. Regulation Z was passed, Truth in Lending. And to show you how naive one person can be, I thought it's the last regulation we could have because we'd gotten to Z. Well, was I surprised.
How else could one do it? You'd gotten to the last
Well,
letter.
that's
End
what
of
I
regulations.
thought, end of regulations. But no, we came along to 1970, and the Bank Secrecy Act was passed. I don't think many people, myself included, expected that bank secrecy would get to be such a big thing. I don't think most of us in 1970 believed that 25 years later we'd have all these currency transaction reports, that we would effectively be agents of the IRS, trying to tattletale on customers or people who we thought might be customers. And that's a real problem for many of us, not just the cost again, not just the aggravation, but the fact that we shouldn't be in this business. At least some of us believe we shouldn't. 1977, the CRA was passed. Justice Department became a big part of where we ought to put branches, whether we ought to loan money to this person or that person. So CRA became a big problem. Then along came the so-called deregulation era, 1980, 1982. 2 acts were passed under the Reagan administration that deregulated some of the things, at least some of the rates that banks could pay. But the reason that had to be done is because of inflation, and everything was going crazy in the early 80s. Then all the problems, of course, showed up. Then we had to have more laws to solve those problems. So we had FREA, or diarrhea, as some people call it, and we had fiducia. So both of those acts came along, created a lot more problem, threw a bunch of bankers in jail, some of whom deserved to be there, some of whom didn't. All kinds of costs, all kinds of regulatory burden.
I'm depressed. Is there any good news?
Well, not much, but there is some. Deregulation today in 1994, 1995, and on beyond is happening. We're getting rid of some of those things. We're peeling those burdens back a bit.
Well, you know, I wish that banking regulations were really all that we had to deal with, but unfortunately there's lots more. And we only have time to list some major regulations which affect all business. Here's our list. We have to deal with payroll tax burdens, making sure that we're doing the right withholding thing. There are the Civil Rights Act that really tell us who to hire, who to fire. There's the Americans with Disabilities Act that does have some fair points. There's sexual harassment. There's age discrimination, and how about the EEOC? Let's look at a clip from one of our TV shows that is talking about what EEOC has to say.
From the EEOC's perspective, is that basically your understanding too? Is that what you're going to try to do, is to make sure that something is there short of a lawsuit to
Whether
settle?
it's the Americans with Disabilities Act or any of the Civil Rights Acts we enforce, we try and go for voluntary compliance. That's why we appear on television programs and speak to groups.
Jackie, I'm not sure that voluntary compliance isn't an oxymoron, with all due respect.
All right. Well, I guess we all voluntarily comply with IRS too, right?
Yes, we do.
Yes. But the idea is that even when we don't use mediation, which is a pilot that we are trying to see if there's a less expensive way of getting the two parties together and comply with the laws. Even when we're investigating a case under our normal procedures, there are various times throughout that we try and work it out.
Okay, as opposed to just automatically going to the courthouse.
Yes. There are fewer than, I think it's only about 1% of the cases we get in the entire year ever go see a courthouse steps. Discharge-related complaints are actually up 33% since 1990. In fact,
There's now a new seminar that I read about in the Wall Street Journal that's entitled How to Legally Fire Employees with Attitude Problems.
Well, if our viewers weren't aggravated when they tuned in, they sure are now.
The good news is that there are efforts at deregulation and that we have some solutions to this challenge.
That's right, Nikki. The ABA, along with independent and state organizations, are having some real success in getting regulatory relief. And for most of those laws, the politics are simply either someone wants to do good things for people or they want to use government to gain a competitive advantage.
So that either way, you need to be involved politically. But that's a subject for another time. Thanks for joining us.
See you next time.
I don't like competition. It's too difficult, and it's getting more difficult. As a matter of fact, as you know, I like to predict the future, and I stake my reputation on being right. Let me predict the future, and I'll be right, and that is that competition will become more so as every year unfolds. It'll get more and more competitive. You know the future truth when you hear it, don't you?
Yes, that's pretty profound, Dan. Thank you.
All right. So if that's true, you know what I want to do? Hey, I don't want to compete. It's going to get too difficult. I don't do what you do. You know why? You're already doing it. Why should I bother? When I first started out, I was not in business. Now, you know I've started 5 companies over the years, but in the beginning, I was a science instructor, and I didn't know anything about business. Luckily, I knew that I didn't know anything about how to compete. So when I started my first company, on purpose, I didn't. And let me tell you right now, that was an unbelievably powerful business principle. You see, what I did was I changed the rules. Within the realm of high integrity, honesty, and other values that I'm sure if we surveyed everybody in this audience, we'd come up and say, yeah, these are the important values. Within those values, hey, I want to change the rules because I don't want to compete. The easiest way to change a rule is to use a new tool.
Hello, I'm Dennis McCuistion.
And I'm Nikki McCuistion. And as you might have imagined, this video segment is on competition, and seldom ever does one of our audiences fail to mention competition as one of the top 3 challenges that are facing their financial institutions.
That is certainly true, and there's a good reason for seeing competition as greater than ever before. Let's take a look at some of the competitors that we are aware of. There are 10,000 plus banks, 2,000 plus thrifts, 12,000 plus credit unions, over 5,500 brokerage and investment funds. There are over 950 money market mutual funds, and then you have stock and bond mutual funds of 5,000 or more, plus 8,000 or so insurance companies, another 1,500 mortgage companies. In the old days, we used to know exactly who our competitor was. It was the bank or other financial institution across the street or just down the street. Today, it seems as if everyone is in the financial services business in some form or another.
And they are. And Dennis, the interesting part of it is that you've really only scratched the surface. Let's look at some others who are competing in the financial marketplace. From commercial paper, where now large companies are going directly to the market to borrow those funds, to securitization. We've got captive finance companies from the GMACs to the Fords. There's commercial finance companies like Capital and Heller & Company. And then, of course, everyone's in the credit card business, from the General Motors to the AT&Ts to the GEs to the Bloomingdales. Let's not forget about leasing and some of the challenges that costs and causes. There's Farm Credit System. And how about Microsoft? Now that they're online, we'll all be using Microsoft at 2 o'clock in the morning to buy some financial services. We've got internet. We can just get in front of the computer and start surfing and see what kind of bargains that we can get. I think you'll recall one of our clients, small town in Georgia. From 3 to 5 one morning, he was buying financial products. Here he is a bank president, but he's even using some of these internet services. And we've got check cashing systems. You know, if I go out somewhere else and cash my check, that's a market that now the bank is not getting because people aren't coming into the bank to cash their checks or depositing funds or using some of the other services. They're not even coming in. So I think those are some things that we have to look at. In this segment, we're going to define more clearly for you who the competition is and what they're doing. Challenge you to learn more about your competition, question you as to how you will differentiate yourself and if you really do want to compete. And then finally, show you about 7 ways to compete.
While the number of banks has been shrinking in the last few years, the number of bank branches has not. as you'll see from this graphic. Back in 1934, there were only 2,985 branches. But of course, between then and the 1970s and 80s, you can see the growth on up to 40,000. And even at the end of 1994, about 54,655 branches. So even though the number of banks is declining, the number of offices still continues to increase. The thrifts have obviously had big problems, as over half of the thrifts have disappeared in the last 10 years. Now, what happens with thrift charters in the future and whether they will in fact be banks may have competitive repercussions, to be sure.
The number of credit unions is also shrinking, Dennis, but at least they have some definite competitive advantages vis-a-vis banks. For one thing, they have one or more employer-sponsored groups, and their field of membership continues to expand just about everywhere. The fact that they are member-owned also gives them the benefit of paying no federal income taxes, and that's a major competitive advantage. Now, when you couple that with the fact that some of them get branches in company facilities that are donated free of charge, they have even more ways to compete. Now, earlier in my career, I had actually sold investment products. Today, however, there are over 5,500 brokerage or investment firms. They're all vying for a piece of the consumer and business investment dollar. They are such good competitors for at least 4 reasons. First of all, they have a much lower operating expense, and they're not burdened to the same degree because of regulations. They already know how to sell. Some of them are extremely good at it and very competitive there and assertive. They offer a vast array of products and services, many of which are not currently available from banks and other financial institutions.
That's true, Nikki, and the next one is money market mutual funds, of which there are almost 1,000 of them today with total assets over $650 billion. This is an industry that did not exist 20 years ago, and it has siphoned off many of these billions of dollars from other financial institutions' certificates of deposit. Again, their operating costs are significantly less. They are typically run by well-advertised and well-financed firms, and they are a major source of competition. And speaking of funds, in the early 1980s, there were only about 500 stock and bond mutual funds. That number today is about 5,000. Banks, of course, have started to buy mutual fund companies, such as the Mellon Bank purchase of the Dreyfus funds. And many other banks have started their own mutual funds as well.
Insurance companies have always been large purchasers of bonds and stocks and have made billions of dollars on real estate loans. And that competition continues to increase. To add insult to injury, the insurance company lobby continues to be very successful in preventing banks from competing throughout their product line. Now, of course, mortgage companies have become so numerous and so aggressive today that it's very difficult for traditional financial services to really compete.
Well, beginning in the early 1970s and escalating over the last 25 years, large creditworthy businesses have bypassed banks and gone directly to the commercial paper market. Thus, the best credit quality loans are often not funded by banks at all. The commercial paper market is one aspect of what we normally refer to as securitization, a process by which certain financial institutions package a group of loans ranging from mortgages to credit cards to small business loans, and then take that package directly to the market, again circumventing traditional bank lending.
And what about the captive finance companies like the GMACs and the Ford Motor Credit that we talked about earlier? Not only do they have the advantage of convenience and point-of-sale financing, but in many cases, they can actually beat the rates of traditional financial services institutions as well. Now, if you throw in leasing, and you and I have leased our cars over the last couple of years, Dennis, and probably will continue to do so, then the competitive advantage really turns into their favor. In fact, about 28% of all new cars and trucks sold today are leased, and that percentage is expected to increase to over 40% by the year 2000. Now, what that means from a competitive standpoint is that if you're not in the leasing business today, you should at least look into it, because traditional bank automobile financing is being totally changed by leasing. And then, of course, there are those special promotions that, run several times a year that advertise zero interest rates or low interest rates on certain types of vehicles. While it's true that there almost always is some fine print, nevertheless, those promotions can be extremely effective and very difficult with which to compete.
Well, it's not bad enough that these captive finance companies and equipment dealers on the machinery and farm equipment side get more than their share of the business. But now we have entirely new markets dealing with those people with bad credit. For instance, there is the Credit Acceptance Corporation in Southfield, Michigan. Last year alone, they had revenues of $55 million and income of $20.6 million. They do that by buying indirect used car paper at rates up to 30%. Now, if you remember the bankruptcy chart from the segment on people, you know that there are a lot of people who will make use of alternative financing sources because, frankly, they have very little, if any, choices. Then there are also commercial finance companies, the General Electric Credit Corporation, etc. And even AT&T has started a small business lending corporation. Not only have Merrill Lynch and others gotten into financing businesses, but they have some real advantages because they specialize in asset-based lending. They are largely unregulated and they have no geographic boundaries. A bank client of ours even told us last year that a commercial finance company managed to loan a marginal borrower at prime a 5-year term with virtually nothing down on a very specialized piece of equipment, and they didn't even get personal guarantees. All the banker could do was shake his head because there was no way he could match those terms.
Speaking of flexible, let's talk about credit cards. In 1994, credit card balances outstanding increased by a record 24%. Some banks, such as Wachovia, came out with a card at prime rate, but would you believe an annual $88 fee? But the big thing today in credit cards seems to be cash back. You'll remember when the Discovery card came out, 8 or 9 years ago? And now they're being joined by Chase Cash Builders, Visa, and others offering cash rebates. Now Visa is actually offering business loans by credit card. Now that's probably just as well, because according to a recent study by Arthur Andersen and National Small Business United, some 26% of all small and mid-sized business owners were actually using credit cards to fund their business anyway.
Well, Nikki, the Visa matter is very interesting because what they've been able to do for their banks who use the product is to cut the cost of originating and servicing these loans by about 75%.
Now, while that is true, that is for our segment on profitability, which we're going to be talking about in the next series.
Okay, but one of the very strong competitors for ag banks is the Farm Credit System. Now, while they've had a few problems in the late 1980s due to inflated land values and overly aggressive lending policies, they've really turned their act around and in some cases are actually outperforming banks. In fact, the competition for farm credit has gotten so stiff that the ABA and IBAA have proposed legislation that the Farm Credit System, which is a government-sponsored enterprise, be changed to an entity which more closely resembles the Federal Home Loan Bank system of today.
Your home computer will soon be your banker and broker. That was the headline of a Wall Street Journal article some time back. Well, here's something for you to think about. And all of you know that it's coming in some form. And that's the competition based on technology. Microsoft tried to buy Intuit. They were unsuccessful. However, several banks and other non-financial institutions are now feverishly working on how to provide financial services through the internet. And it appears that the long-awaited time for home banking is certainly here. Now, there may be significant numbers of people today who pay their bills by computer, and that number is certain to increase dramatically in the future. Today, 30% of all households have personal computers. 10% have modems, Dennis.
Now, before we finish our list, it's certainly not a complete list, even with all this we've talked about. We would be remiss if we did not mention the proliferation of check cashing operations as they've carved out the low end of the financial services business. For instance, one of the market leaders is Ace Cash Express, Inc. Now, they're a publicly held company based in our hometown of Irving, Texas. They run a nationwide system of check cashing operations. They're very profitable, and they're now moving into money orders, electronic tax filing, and other services. So there you have it, our list of the competitors in today's market, and there are, of course, many others that we've not taken time to discuss.
Dennis, there's one huge trend that we see and which many banks are not yet concentrating on, and that is finding out more about the competition. You know, in the past, we had a tendency to compare our share of the market with just other financial institutions in our hometowns. Today, because of the brokerage firms and captive finance companies and others who are so active, we really think it's essential to do a lot more market research on the competition, what their strategy is, what their strengths and weaknesses are, and the types of products and services that they offer. For instance, not only do most financial institutions not know much about the competitors' services and products, they don't even know much about their own.
Well, if you're talking about the Bank Marketing Association study and a recent update, then you're exactly right.
That's what I'm talking about. Because in 1988, the Bank Marketing Association did a study in which they tested bank employees for their understanding of the products and services that their bank offered. The bank employees scored 44 out of a possible 100. Bank customers scored 36. So, only an 8-point difference is not good enough, and it's certainly not good enough to remain competitive. Now, there was another study done in 1993 that confirmed those results. In fact, the clients that we work with all have the same problems, and that's why we definitely recommend that each of you design a product manual that's going to make sure that every employee in your bank understands enough about what it means to provide superior service and understand products.
Well, as many of you know, we spend a lot of our time in financial institutions facilitating strategic planning sessions. If there were no competition, there would be little use for strategy. The questions we pose to you are these. How will you compete in the future? Will you be a low-cost provider? And frankly, most financial institutions can't be. And if not, how will you differentiate yourself from the competition? What are your competitive advantages? What kind of marketplace are you in? And what is the turbulence level in that market? And do you really want to compete given the fact that many of you are still paying significantly below market rates on interest-bearing deposits because you're trying to maintain your net interest margin at today's high levels?
Dan Burrows, in his book called Technotrends, identified 7 ways in which to compete. Let's quickly look at those. The first one is obvious, as we have to compete on many occasions on price. Some of the competitors that we have talked about have definite advantages by being able to pay high rates and being able to charge lower rates. So price is an obvious way that we can compete, but a difficult one for us because of the bottom line constraints. The next two are reputation and image. And to the extent that we are able to compete in these areas, price may not be too big a factor. The next two are time and innovation. And these are 2 things that many financial institutions have not been able to compete on. But we think that successful ones will be able to compete on these bases in the future. Then finally, there's values and service-based ways of competition, ways that traditional financial institutions have gotten and kept business with over the years. To really differentiate in this area is not easy. And we'll talk about that in the next segment on solutions to some of these challenges.
It should be obvious to you that this challenge of competition is just that, a challenge. There are many in our industry, including industry expert Annette Bird, who believe that banks must be able to derive a significant portion of their income from non-interest sources and other off-balance sheet opportunities. We agree with that. But talking about it and getting it done are 2 different things. Now, we hope that information on this tape will motivate you to find new and innovative ways to compete, and that you'll study carefully all the 7 solutions as we identify ways to help you do so. Thanks for joining us. Hello, I'm Dennis McCuistion. Welcome to this segment of the 7 challenges on the subject of profitability. Now, the question is, why, here in late 1995, are we discussing profitability?
I'm Nikki McCuistion, and the answer is when we first began researching our book, The 7 Challenges Facing Bankers in the Future and How to Meet Them, it was 1991, and bank profits looked something like this. Bank profits, as measured by return on assets, had been on a steady decline due to several factors. As Reg Q was phased out, deposits cost more, and as more real estate loans were made and then became problems, losses increased. And of course, the ups and downs of the economy, coupled with increased competition, all led to major challenges in profitability.
Well, but then there began to be much better news. Here's a graph showing ROA for 1991 through 1994. While ROA dropped slightly from 1993 to 1994, the earnings of $43.1 billion in 1993 and $44.7 billion are industry records.
So Dennis, why are we still talking about profitability as a challenge?
Well, let me see the hands of all you bankers who think you've just gotten smarter in the last 3 years. There's an old saying, never confuse a bull market with brains. And by that I mean many banks have made these profits thanks to fortune, not good strategy. And that brings us to our objectives for this session. We want to look at how the other challenges affect profitability. We want to look at problem loans and their impact on past and future profitability. To discuss why financial executives still worry about profitability, and to lay out what we believe are the keys to long-term profitability.
So let's get started, Dennis, and let me first point out how several of the other challenges affect profitability. Of course, the one of people. You know, there's a cost to downsizing, and there's rewards to downsizing. The trend toward performance compensation needs to be looked at. We need to look at change and, of course, the consolidation issues. Dennis, what's the impact?
Well, the question is this. Have all these mergers had a positive impact on the bottom line? And the answer is no and yes. In the beginning, most of the mergers, most of these consolidations didn't really bring any more profit to the bottom line. In fact, a lot of people would say they simply paid too high a price. Now, the good news is, especially for the people who are doing the acquiring today, is that the bottom line is looking better today because I think they're acquiring banks smarter. The bad news is the prices are so high today, there's liable to be some deals made that are not all that great. Now, before we move on, we'd like to recommend a book to you called Bottom Line Banking, written by John McCoy of Bank One and a couple of people from First Manhattan Consulting in New York. Frankly, it's a better book than ours. We hate to admit it. It is something that every CEO watching this tape needs to read. Bottom Line Banking, and obviously everybody should read our book too, but you must read that book. The questions are the economies of scale increasing? And I think to some extent the answer to that is true. The ability to spend money on technology is greater at larger banks, so that gives them the competitive advantage and makes it easier to make more money. And then, of course, there are some exceptions because a lot of the smaller banks that we're seeing, Nikki, are actually spending money on technology, including a little $50 million bank in Missouri that I know of who spent $500,000 last year alone on new technology.
Then there are those issues of cost that are due to regulations. Here's what I think is a real good approach to this problem.
Well, it is, Nikki. It is a brochure from National City Bank in Indianapolis, and this brochure is on the teller counters, and it's on the counters for the customers to deal with in the lobby, so that the customers can clearly see what these regulatory costs do to banks. And it shows that the costs that regulations put on banks have to be passed to the customers. And when that's read by a customer, they know the impact of those regulations, and hopefully will feel better about some of these bank fees that are having to go up as a result.
So it may combat some of those studies that are coming out saying that banks are raising their fees. There's a reason.
Yeah, we certainly hope so anyway. The other thing is, we mentioned in an earlier segment that some of the larger banks are using these regulations as a competitive tool against some of the smaller banks, and that's why we need to get those costs down, among other reasons.
I agree. And I think the impact on profits from competition is obvious. Many mutual funds have a family of funds that enable a consumer to keep part of his or her funds in one and part in the other.
And in fact, according to Bottom Line Banking, it costs about 50 basis points for a money market mutual fund to deliver a savings product, whereas in most banks it costs about 300 basis points. So you see, they can easily pay higher rates and still have a better profit margin. Then there are the competitors on the loan side who aren't as regulated, don't have a bank's cost structures, and in the case of credit unions, are not taxed.
Well, Dennis, let's turn now to the subject of problem loans. When we first met about, 10 years ago, you were heavily involved in some of these problems, not as a banker, but as a consultant. Let's tell our viewers about your experience and what we're seeing today that really concerns us.
Well, back in 1986, there were major problems. When you and I first met, I was involved in helping banks, actually buying banks out that were closing, and I had to tell several boards of directors that their banks were broke. It was a difficult thing to do, and it became so difficult, someone said, Dennis, why don't you just write a book about it? So I wrote a book about it in 1988. After that time, one of the large banks in Dallas closed, and you're about to see a video clip of the two people who combined their banks to create what was at that time the largest bank failure in the history of the United States?
Well, it was unquestionably the saddest event, you know, in my life and professional career. It was a situation that was made all the more difficult because of the forces, as we already discussed in large measure, being absolutely outside of our ability to control it, starting with the Saudis' decision on oil and then, you know, moving through some of the excesses that were in real estate that were largely, at least in my humble opinion, created by unregulated, unsupervised thrift actions. But it kind of polluted the whole territory. So there was no question that it was a very, very difficult time. However, I would have to say this, that in view of those elements over which we had no control taking place, the fact that there was this ability of NCNB, in this particular case, to come in and bring capital with the government's help to recapitalize the bank, that particular banking house or banking institution for the benefit of the customers, was a very strong thing, very, very positive thing. There, I suppose in the final analysis, you know, you just can't be very, if you're part of that management group, as Harvey and I were, you got to have a lot of hurt for the shareholders and the creditors who were wiped out, and a lot of the management jobs and a lot of the people that were damaged. But the fact is that the customers were protected. There weren't any dollars lost at all, and the fact is that the economy now is going to be helped by the fact that NCNB and now Bank One are back, you know, with stronger capital.
Those were interesting times, but now I want you to look at some good news. As you'll see, the number of problem banks and the asset size in those problem banks is down significantly over the last few years. So what's the bad news? The bad news is we see some of the same trends occurring throughout the country today, and that is we see credit quality lessening. Alan Greenspan, who is obviously the chairman of the Federal Reserve Board, put it this way at last year's ABA convention when he said this. He said, competition among banks and between banks and their non-bank competitors has never been greater. Credit standards have weakened.
So in that case, what should financial institutions be doing?
Well, I think they should be doing several things. First, they should measure and price risk. Don't charge everybody the same rate. Measure that risk and then price for it. Secondly, don't let your competitors force you to do something stupid, which is what some people say happened in the late 80s. Third, watch your delinquencies. After historic lows in early 1994, they're now creeping up again, so take a look at them and keep on top of them.
And moving on to our third objective in the segment, why do you think that financial institutions are still worried about profitability?
Well, I don't know, but I get calls from all sorts of financial institutions and associations that want me to do a program entitled, Am I Dreaming, or Can We Keep on Making This Much Money Each Month? I think they're concerned about dealing with a shrinking net interest margin. They're concerned that some of the non-financial competitors are going to be able to charge lower rates, and some of the people are going to be charging higher rates, or I should say paying higher rates, so that margin's going to shrink. And when it does, we still haven't dealt effectively with the cost problem, because even though profitability has been going up, for most banks, their efficiency ratios have not gone down, and so we're still dealing with those kinds of issues. Now, you'll see these efficiency ratios here at the 50 large banks. Now, I've sort of combined them there and averaged them for you. You see the low-cost banks, and they're mean, and the average cost banks, and they're mean, and it's only in the high-cost banks that the efficiency ratio has actually gone down. So there are many banks still having cost problems, so layoffs, et cetera, are probably going to continue. One of the things we suggest is external benchmarking with definite goals in mind that may work for you.
And I think we also should look at, or at least touch on briefly, process reengineering. Even though that's a management buzzword, and in many cases it's not working, as the studies and statistics are showing, there are still some good points that are telling us, take a look at how we're doing business, see how we can best utilize people, and in fact, rather than just paying lip service, let's make sure that we're treating people as our most important asset. When it doesn't work, it's usually because it has not been well strategized and management is not buying into the whole process. We also have to take a look at more products and more services, and certainly make sure that we're getting more fee income where we can.
Well, fee income, what about the $3 First Chicago charge that made big news earlier this year?
Well, it's not just First Chicago. There are quite a few banks that have now jumped on that bandwagon because they realize that segmenting the market and making sure that you're providing different things to different people works.
Well, that's true, but we have a lot of public interest groups. There's a big flap over fees in general, as all of you know. The Consumer Federation of America is one group that's talking about it. Just this week, the U.S. Public Interest Research Group came out with another study that showed that banks' fees were going up. And the thing is, somehow they believe that we are regulated utilities. We're not. A lot of them are getting government money to run these studies, which is really a problem. But I think some of the consumers have a legitimate gripe, because one of their biggest gripes is charging for deposit items returned. And yet, it's difficult, but because studies clearly show that 50 to 60% or more of a bank's customers are unprofitable. You know, I think the old 80-20 Pareto principle rule probably works here, Nikki, that about 80% of our profits come from 20% of our customers.
The book written by Action Systems says that a typical customer costs us $225 a year to serve, but they provide only $125 in revenue. Now, what this means is that we really need to know our cost and who's profitable.
And we need to know our A, B, and C customers. The A ones that make us some money, the C ones that cost us all the money, and the Bs that are somewhere in the middle. So let's wrap up with some keys to long-term future profitability. First, vigilance in interest rates to maintain our net interest margin. Second, constant improvement on efficiencies of operation. Third, pay people for performance. And next, a strategy to somehow increase fee income. Then measure everything that moves.
And Dennis, it's something that people really have to give careful thought to, because sometimes they don't, and yet they still expect productivity and performance to go up. So, thanks for being with us. And as a bonus, here are 20 ideas out of 110 in our book that financial institutions are using to increase their bottom line.
Now, what we'd want you to do is pick one or two of these things and really concentrate on them. See you next time. Hello, I'm Dennis McCuistion. Thanks for taking the time to join us.
And I'm Nikki McCuistion, and this is going to be a very short segment due to time. And in fact, we have 3 objectives for you. The first one is to make a case for time being a challenge. The second, to discuss the customer's expectations. And thirdly, to suggest ways that you can deal positively with time.
Well, the first thing we'll do is to give you a couple of definitions of time. This one comes from Charles Hobbs, and he says time is the occurrence of events one after the other. The second one comes from Alan Lakin, who defines time simply as life. And then there's Benjamin Franklin, who says that, as you might imagine, time is money. Now, this is our favorite quote because time has become such a big factor, and it comes from Dan Burrus when he says time is the currency of the 90s.
Dennis, let's talk a few minutes about why time is such a challenge.
Now, wait a minute, Nikki. I thought you always referred to challenges as opportunities.
Well, I do, and that's true. But I find myself many times surrounded by insurmountable opportunities, and time is a challenge for financial executives today, specifically as it relates to 3 of the other challenges: that of people, that of change, and that of profitability. So first, let's talk about people. There are 4 key points that we'd like to make: lean and mean, personal versus business, women with children, and the 25% factor.
The idea of lean and mean, or as we prefer it, lean and green, is obvious from the information we gave you in dealing with people and all the layoffs that are happening in the financial service industry. Ask yourself this question: are you being asked to do more with less people around you than you were 5 years ago, last year, or even last month? Do you remember the old rule of thumb that we have 1 employee for every 1 million in assets? Well, ask yourself what the rule of thumb is today. And the answer for most bankers is a minimum of 2 million in assets to 1 employee. And of course, as banks get really big, those numbers don't have any validity either. Many banks are, in fact, looking at 3 million to 1 as their benchmark, and you should look at whatever your peer group numbers happen to be. Now, what this translates to is that we can ill afford to be ineffective when we are on the job.
And Dennis, that's one of the problems that bankers face. The old adage about bankers' hours was never really valid, but it's even less valid today as we try to juggle our personal responsibilities and our time on the job. A lot of people talk about this issue as a question of balance. That is, getting balance in our life between our personal and our business areas. but we like the word juggle a lot better, because with financial services employees like you, it's obvious that you have many hats to wear. You know, for instance, most officer personnel not only wear hats as employees, but you're also wearing hats from the Chamber of Commerce, you're wearing service club hats, you're wearing charity fund drive hats, you're wearing church and school hats, and who knows what else. Trying to combine those with the hats that you have as parents, as spouse, as sibling, as child, all make it really difficult to do justice to any of those balls that we juggle. In fact, our friend Jim Krupe put it well when he said that some of the balls that we juggle are rubber balls, and some of the balls are glass balls. Our job is to know which ones are rubber and which ones are glass, because if we let the rubber balls down, they'll bounce back up. But if we let the glass, the really important things in life, hit the ground, then they'll shatter along with a large part of our life. And that brings up the next topic, that of women with kids. Now, the chances that 3 out of 4 of you watching this tape are women, because women are much more numerous in the financial service workplace than men. The odds are, too, is that you're going to have kids either in school or in preschool, and that means a doubly difficult job, because it typically falls on the woman to deal with those kinds of family issues, even though that's somewhat changed now. Now, combine the inevitable need to take care of the family with the concept of lean and green, and you can see the real challenge in this.
That's really true, Nikki. And if our viewer happens to be a top executive, they have the 25% factor to worry about. Now, with the 25% factor, we simply mean this. Studies have been done that show that most top executives do approximately 10 hours work at home during the week. Now, what that translates to is another 3 months a year on the job, or 25%, which is where we got the 25% factor. Now, those in our generation and older have come to expect this, but the new generation, the 20-somethings we talked about in the people segment, don't have any intention of letting that happen to them, and we wish them well if they can pull it off. Interestingly enough, it is the baby boomer generation, those born between 1946 and 1964, who are most likely to be dissatisfied on the job, and this time pressure is one of those dissatisfiers.
Now, let's look at how the time challenge interacts with the challenge of change. One of the solutions to these challenges that we'll share with you on another segment is that of sales culture. In the sales culture work that Dennis and I have done with financial institutions across the country, one of the major obstacles in getting a sales culture implemented is, when do you have the time? You still have to do everything else, too. So, as a result, we typically do at least 1 day of time management as part of that sales culture work. One of the problems is that when do we find the time to keep up with the changes going on in this industry? For example, how do we keep up with the latest software that's on the computer? How do you learn all of that and still do the job that you have to do every day? How do we keep up with the regulations that are constantly changing? And how do we keep up with the changing line of products and services that we offer if we really are going to get to know them? Do you begin to see why that time is really such a big challenge? Let's take a historical look at time and apply it to the Pareto principle. You may remember that the Pareto principle basically says that if we had all items arranged in the order of their value, 80% of that value would come from only 20% of the items. The remaining 20% of the value would come from 80% of the items. In other words, about 20% of what we do really creates most of the value. Our objective then is to figure out what that 20% is and to do it.
But time has a lot to do with profitability, because one of the reasons for all the layoffs is to increase the ability of financial institutions like yours to compete profitably. The latest buzzword of the day is process reengineering. Many institutions, and perhaps yours included, are involved or will be involved in fundamentally rethinking how most things are done in the institution. This will be difficult, but it's essential in order to compete. And one last thing before we move to the customer's perspective on time, and that is the economist's way of looking at time. That's what we call opportunity cost. For instance, there's always a conflict between, let's say, an executive and a support person doing a particular job. For example, assume that an employee who makes $40 an hour spends 2 minutes going to the fax or copy machine. That person has an opportunity cost 4 times as high as someone making, let's say, $10 an hour. That's why the higher paid you are, It's much more efficient to get someone else to do the jobs for you if they're making less money. Now, the problem with all this is that some of you who are in support jobs may resent it, but you shouldn't. It's simply good economics. Now, the last thing, I don't know how this works out with people working on their own computer. I don't know what the economics of that are, and I'm not going to get to that at this point anyway, so what the heck. We'll worry about that as computers come along.
Well, I think we need to turn to the issue of customer expectations, because if we think we have time problems, what about the customers? They've become accustomed to getting service instantly, and that's one of the reasons the use of ATM machines and other forms of technology, such as the telephone, in order to do banking has increased so rapidly. Now, customers no longer have time to come to the bank or to the branch, and yet they want to have access 7 days a week, 24 hours a day, and the advent of banking by computer at home is already allowing customers to do this, get that access, and this is going to intensify in the future. In fact, many customers do business with captive finance companies when financing automobiles or other capital goods because of the convenience factor that saves them time. To most customers today, time really is money. Just like to the investment division of your financial institution, an investment not made today is gone forever.
Well, let's talk about ways to deal with the challenge of time. Some of these ideas are going to be ones you've heard many times before, but here goes. First, set goals. Second, set aside blocks of time to accomplish your important things. And then finally, work on important versus urgent things. Franklin Field put it well when he said, "The great dividing line between success and failure can be expressed in 5 words, I did not have time." We believe that you do have time, since everyone has all the time there is. And in fact, there's no such thing as a lack of time.
We get to speak a lot on setting goals and the importance of really living your life to the fullest. We believe that you can have almost anything you want in life. It's just that you can't have everything you want in life. As a result, one has to decide what one wants, and that's the purpose of goal setting. Then set aside the time to accomplish those goals and work on the most important things first.
You know, Nikki, it's interesting because many of us have spent a lot of hours at our desk. But as the old saying goes, I don't know anyone who on their deathbed would say, I just wish I'd spent a couple more hours a week at the office.
You're right. I know exactly what you mean. And now let's close with one of our favorite quotes. It goes something like this. Yesterday is a canceled check. Tomorrow is a promissory note. Today is the only cash we have. Spend it well. Thanks for joining us.
We really appreciate your time.
Well, the first thing you realize is there is a national attitude about the current tax code. Frankly, the American people are fed up with it. They insist that it be replaced with something. At this time, I think there are basically 2 competing ideas. One is a national sales tax, which is advanced by people who call themselves Citizens for Alternative Tax System, and the other is a flat tax. There seems to be a very clear consensus that the current tax system must go, and a pretty clear predilection, I think, that it will be replaced by one of these 2 options.
Hi, I'm Nikki McCuistion, and you're probably wondering why we started with a clip from our television show entitled, Is America Ready for the Flat Tax?
Well, I'm Dennis McCuistion, and the reason is that everything would change if the flat tax or national sales tax should be passed and replace the income tax code as we presently know it.
For one thing, the mortgage interest deduction would be eliminated, and that would probably change the real estate market, and perhaps the collateral that you held on a big part of your portfolio. And it might even change the whole complexion of the tax-exempt bond market. And that's why we have these 3 objectives for you for this particular segment. To emphasize the role of government policy on the financial services industry, to discuss the role of globalization of financial services, and challenge you to really think about these economic issues.
See, our belief is that you cannot divorce economic conditions today from politics. In fact, it was Marx who defined politics this way. He said, politics is the art of looking for trouble, finding it everywhere, diagnosing it wrong, and applying unsuitable remedies. Now, of course, this was Groucho Marx, not Karl Marx. But nevertheless, we also believe that Eugene W. Baer had it right when he said the following: what's good politics is bad economics. What's bad politics is good economics. What's good economics is bad politics. And what's bad economics is good politics. Now, I hope you followed all that, because finally, for those of you who believe, as we do, that the federal government is not much of a role model, we give you a quote from Josh Billings, who said this: live within your income, even if you have to borrow to do so.
Very funny, Dennis, but what are you really saying
Well,
here?
what I'm saying is that the poor government policy that broke the S&L industry in this country and caused major shakeups in the banking industry, which just over 4 years ago was what caused Business Week to have on its front cover this quote: the banking industry, as we know it, is dying. Now, back when that quote was on the cover of Business Week, everyone was concerned about all the banks' closings. And as you will see from this chart, there have certainly been a lot of closings in the United States in the past 14 years, many of which you will also see were from Texas. Of course, most of those bank closings were as a result of bad loans. And you'll see from the next graph that the historical charge-off rate banks experienced in the 1950s and 60s started to go totally haywire in the early 70s and continued on up until the last year or two.
Well, that's all very well and good, but I think it would be appropriate if we explain to our viewers what we really believe were the underlying causes here.
Well, I'll be glad to do that, but I'm not sure if they can stand another trip back into the annals of history like we did on regulations.
Okay, I know it's going to be difficult, and try to be brief. And even though you're not an economist, I know you're going to sound like one. So I'm reminded of this old joke, and that is, if you laid all the economists in the world end to end, they still wouldn't reach a conclusion.
Yeah, that's very funny too, Nikki. Well, let's go back to one of our major premises, and that is this: that government has been involved with banking almost from the beginning, and due to fighting wars and other reasons, has always wanted to create money to serve whatever political purposes were expedient at the time. Many of you will recall the saying, "not worth a continental." That came about because a Continental Congress during our Revolutionary War decided to issue fiat, or paper currency, and required it to be legal tender. Of course, it soon became close to worthless, and we're lucky that we won the war because the monetary problems could have been more difficult than the British. Now, the first and second banks of the United States were founded in 1791 and in 1816, each of which had a charter for 20 years, and each of which was designed to serve government purposes. But Andrew Jackson decided not to renew the charter of the Second Bank of the United States in 1836. That led us to the period of time from 1836 to 1863, or perhaps even on up to 1913, that is typically called the free banking period. Now, during that time, there were some problems in the banking industry, to be sure, but it was a period of growth throughout the country, and most privately run banks did very well. Unfortunately, in the mid-1860s, there was a war fought, which we in the South call the War of Northern Aggression.
What do you mean, the War of Northern Aggression? That was the Civil War. I am, after all, a New Yorker, as you will recall, so let's get this straight.
Well, you may be a New Yorker, and I'll admit that it's called the Civil War, but I will not back off on my definition. But here I'm not going to talk about that war. I'm going to talk about what was done with money. In 1862, a Legal Tender Act was passed, and greenbacks were created and made legal tender, which, obviously, depreciated significantly in value. Now, I've already talked about the National Banking Act of 1863, which created the Office of the Comptroller of the Currency, which was the first bank regulator. But because of deficiencies in that National Banking Act, there were a series of panics that took place in 1873, 1893, and 1907, among other times. And so in order to correct faulty government policy, you might imagine there was more faulty government policy. In fact, many people hail the passage of the Federal Reserve Act in 1913 as a positive event, but some of us are a bit more skeptical. President Wilson threatened to hold Congress over the Christmas holidays and not let them go home to their families if they didn't pass that act. And they did so, at the last minute on December the 23rd, 1913. Now, that was also the year that the income tax law was passed. It's highly ironic that the Fed was formed to prevent the types of panics and instability that had been occurring over the past 50 or 60 years, because as you'll see in this graph, the Consumer Price Index was little changed from the early 1800s until the time the Fed was formed in 1913. Then, of course, we have to talk about the Great Depression, which was a time in which 10,000 banks closed and many people lost their money. Now, there was actually about $10 billion in today's dollars that was lost by depositors during the period from 1929 to 1933. But the question is, why did the Great Depression happen? Now, without getting into too much detail, it's fairly well agreed and documented that it was poor government policy, trying to keep wage rates above the market clearing price, and the lack of understanding on the part of the Federal Reserve, which, in spite of low interest rates, allowed the money supply to decline by about 25% over this period of time.
Well, Dennis, what was the response of government to this situation?
Franklin Delano Roosevelt was elected, and there had been a movement for some time to establish a system of deposit insurance. But when he ran for president, he ran and he campaigned against deposit insurance. However, not unlike some recent presidents that we can recall, he changed his mind shortly after being elected, and he declared a bank holiday early in 1933. Now, at that time, he confiscated all the citizens' gold and replaced it with paper money. Thus, he completed the biggest part of nationalizing of money that began with the passage of the National Banking Act 70 years earlier. Now, the FDIC and the FSLIC were both created about that time and began operations in 1934. And after that, the banking industry did stabilize for several years. Now, I want to talk just briefly about September 9th, 1960, because it's a date that most people don't remember. But it is a date in which two countries got together to form OPEC, the Organization of Petroleum Exporting Countries. And I bet you don't know, Nikki, what those two countries were.
Well, yes, I do. Well, why don't we let the viewer guess? Well, if they had the time, I'd venture to say that they'd say it was Saudi Arabia and Venezuela.
Absolutely right, Nikki, 100% correct. That particular cartel didn't have too much impact until a few years later, as we'll see. Now, in 1965, LBJ was president, and he attempted to fight the war in Vietnam and the war on poverty at the same time without raising taxes. He started to monetize the deficit, creating even more inflation, as you'll see from looking at the Consumer Price Index graph one more time. Now, the folks in the Middle East and the folks in France in particular got tired of receiving dollars that were worth less and less all the time. And they started to ship the dollars back to the United States and wanted gold for it, at which time President Nixon cut the ties with gold on the 15th of August, 1971, and he put wage and price controls in place. Now, obviously, it didn't work. And as you can see from the graph, this marks a time in which inflation in this country really took off, as there was nothing left to tie the dollar to other than the good sense of politicians, which is fairly much in short supply. Well, to make a long story short, inflation broke the savings and loans as it was running at 13.5% in 1980. And the prime rate, of course, hit 21.5% about that same time. Those things led to more government policies. And so the two so-called deregulation bills of 1980 and 1982 were passed. Ronald Reagan was elected president about this time and amidst all this, and he passed the Economic Recovery Tax Act of 1981, which spawned a real estate boom in this country because it lowered the depreciation schedules and cut tax rates. Then, of course, Congress reversed itself in 1986 with the Tax Reform Act of that year. And rates continue their yo-yo from one period to the next, as you'll see in the next graph. Now, with rates going all over the place, that made the running of any financial institution an absolute nightmare. So government continued to run significant deficits and, in fact, has not balanced its budget since 1969, as you'll see on these numbers on the next graph.
You're really depressing me, Dennis. And what about the second point? Globalization. If you're through talking about what happened to the S&Ls and why all those banks got into trouble, let's go on with that. It seems to me that we have a lot of trade going on right now, and that trade is good. So these references to August 15th, 1971 really scare me, Because what's happened to the dollar and the yen ratio since that time?
Well, that's a good question. And some of my economist friends would say that the devaluation of the dollar against the yen is good, and some would say it's bad, and I agree with some of my friends. You know, but the rate has actually gone down from about 300 yen to the dollar to about 90 to the dollar today, so it's really a problem. And my biggest concern, though, is with the Japanese banks today. And the reason I say that is I had an opportunity to speak for a Japanese corporation about 4 years ago, and I predicted a major problem with their banks. And they haven't invited me back since, I might add. But I'm afraid that that concern cannot be swept under the carpet in Japan for much longer. Now, the problem is the whole international situation is extremely volatile, as the dollar still serves as a reserve currency, and about the only people making money are the currency speculators. Now, the NAFTA and Mexico problems of earlier this year have also been a real challenge for certain parts of the country, and of course been a political football.
At least we've gotten folks to think about some of these issues, and how about a little bit more to think about? The economy is not controllable by you. It is external, but you still need to keep up with what is going on as best that you can, especially on a local and state level. So get those numbers, look at them, and make some decisions based upon what you know about the economy, even if you can't change it. Also, we recommend that every financial executive read the Wall Street Journal every single day.
Watch bank stock prices. Right now, they're very good with high earnings. And of course, these are fueling mergers. As John McCoy said, market capitalization is ultimately the best test of performance. But the question is, can the stock market, running now at almost 4,700, be sustained? And what are the implications for you and your product line if it can, or if it can't?
Now that you've shifted the interest rate risk to your customers through mostly floating rate loans, I hope that you'll try to keep up with those customers and who they are by looking carefully at broad demographic changes, because they affect the rate of savings and borrowing, and there are a lot of implications for you strategically as to what products you should be providing for them.
And let's don't forget about the implications of technology on employment. Can technology continue to create more jobs that it eliminates? If so, are the people who work in these high-tech industries capable of doing so with the skill level they have right now?
And finally, what about tax rates? If you're as concerned about the possibility of a major change in taxes, we suggest that you call 1-800-9-FLAT-TAX and order a book called The Flat Tax by a couple of economists at Stanford named Robert Hall and Alvin Rabushka. Or else, you can call us at our 800 number, which is 1-800-543-0310, and order a copy of our video so that you can see what Dick Armey really has to say about the flat tax.
Okay, that's it for now. We wish you all the best in meeting these challenges. Be with us soon for the 7 solutions.
To recap, the 7 challenges we've talked about in this series are people and change, regulations, competition, profitability, time, and the economy. If you can meet these challenges, you're going to do very, very well in this industry.
It's been great being with you.